You're listening to Nora and Noah Decode the Day, where markets meet meaning every morning.
Welcome to the Deep Dive. Today, we're really zeroing in on what Federal Reserve Chair Jerome Powell has been saying lately.
That's right. Specifically about interest rates and also, the potential impact of tariffs on the U.S. economy. Big topics.
Definitely. We're looking mainly at his comments after the last big Fed meeting, the FOMC meeting.
Yeah.
And our mission really is to help you understand the takeaways, what the Fed's thinking, what these tariffs could mean, without hopefully making your head spin with econ speak.
Exactly. And the context here is pretty important. The Fed just held rates steady.
Right.
But at the same time, there's all this talk, this uncertainty swirling around trade policy. So we want to cut through that a bit.
Okay, let's dive right in then. One of the main things Powell said was essentially the Fed isn't feeling rushed to change interest rates.
He used phrases like, not in a hurry, wait and see how things evolve.
And that came right after they decided to keep that main interest rate, the federal funds rate, unchanged. It's still in that 4.25% to 4.5% range.
Right. And maybe just a quick reminder on that rate.
Yeah, good point. What is that exactly?
Well, basically, it's the rate banks charge each other for overnight loans. Think of it as the Fed's primary tool.
Okay.
Sort of ripples out, influencing other rates, credit cards, mortgages, business loans, you name it.
Gotcha. So this wait-and-see stance, why now? What are they waiting for?
Well, that's the million-dollar question, isn't it? They're essentially saying they need clearer signals from the economy.
Signals about what specifically?
Mostly about how these tariffs, if they happen or get bigger, actually affect things, like import prices, business confidence.
Okay. So they want actual data, not just speculation.
Precisely. So, keep an eye on things like the next inflation numbers, business investment reports. Those will be telling.
So it sounds like these potential tariffs are casting a pretty big shadow over their thinking.
Oh, absolutely. Powell was quite direct about it. He warned that if we see sustained large tariff hikes, it's likely to cause a nasty combination. Higher inflation, slower economic growth, and more unemployment.
Wow, okay. That hits all the major economic nerves, doesn't it?
It really does. It's that sort of double risk. Tariffs can push up the prices of imported stuff directly. That's the inflation part.
Right, things you buy getting more expensive.
Exactly. But then those higher costs, plus the general uncertainty, can make businesses and maybe even consumers pull back on spending.
Which leads to the slower growth and potential job losses.
Yep. And Powell also touched on this interesting point about how long the inflation might last. He said, well, maybe the initial price jump is short-lived, like a one-off adjustment.
Okay, like a temporary bump.
But he also acknowledged the risk that it could become more persistent. And that's what the Fed really, really wants to avoid. Persistent high inflation.
Which explains the caution, I guess. This ties into what the FOMC itself said, right? About increased uncertainty.
It does. Their official statement mentioned, and I'm paraphrasing slightly, that uncertainty about the economic outlook has increased further.
And they specifically mentioned the risks for both unemployment and inflation going up.
Yes. The risks of higher unemployment and higher inflation have risen. It signals they see potential trouble brewing on both fronts.
So what does that mean practically, this increased uncertainty for their decision-making?
Well, it makes their job much harder. The Fed has these two main goals, right? Price stability and maximum employment.
The dual mandate.
Exactly.
Yeah.
Tariffs could potentially force those goals into conflict.
How so?
Think about it.
Yeah.
If tariffs push inflation up but also slow the economy, what does the Fed do? Do they raise rates to fight inflation, even if it hurts jobs more?
Or do they maybe cut rates to support growth, but risk letting inflation get worse?
Precisely. It's a real policy dilemma, a very tricky balancing act.
Now, adding another layer here, there's the perspective from the White House. President Trump has been pretty vocal about wanting lower interest rates.
Yes, that's been a recurring theme. He's repeatedly called on the Fed to cut borrowing costs.
Which is quite different from the Fed's current message of patience.
It's a clear contrast. You have the president pushing for stimulus through lower rates, and the Fed saying, hold on, we need to see the data, especially with these tariff risks potentially pushing inflation up.
And we should probably note, just for context, the president has criticized Powell in the past, even mentioning potentially firing him.
Right. That history exists. And it highlights the importance of the Fed's independence. The idea is they make decisions based on economics, not politics.
So despite all that noise and the economic uncertainty, the Fed seems laser focused on inflation.
Very much so. Powell and others have been quite clear. They are determined not to let tariffs cause a lasting surge in inflation.
And that means they're probably not going to cut rates just to cushion a potential tariff-induced slowdown, right? They won't act preemptively.
That seems to be the message. Powell actually said something quite explicit on this.
Oh, yeah.
He said, it's not a situation where we can be preemptive because we actually don't know what the right response will be until we see more data.
Okay, so show us the data first.
Basically, yes. We need to see how these tariffs actually hit the economy before we react. It really underlines their data-dependent approach right now.
It's fascinating because the data we do have seems a bit mixed. Like, you hear reports some businesses are holding off on investments because of the trade situation.
That's right. That's a direct consequence of the uncertainty. It's hard to plan big projects when you don't know your future costs.
But then you look at the jobs market.
And it was pretty healthy. April saw, 177,000 jobs added? The Fed itself called that solid.
Yeah, solid. And didn't the economy actually shrink a bit at the start of the year? But underlying demand is still strong.
Correct. A slight contraction, but the Fed noted that underlying private demand continued at a solid pace.
And there's that weird situation with imports. Companies rushing them in before tariffs hit.
Yeah, some reports suggested companies were front-loading imports. And consumer spending also jumped in March. Maybe some of that was trying to buy before potential price hikes, too.
Plus, some inflation measures actually cooled off a bit that month, so a lot of conflicting signals.
It really is. You've got strong jobs, decent underlying demand, but also that earlier GDP dip, investment worries, and the big question mark over tariffs. It paints a complex picture for the Fed to navigate.
These specific examples, like the import surge or the job numbers, really help ground it, though.
Definitely. They show the different forces pulling the economy.
Okay, one more technical point they addressed. The balance sheet, they're still shrinking it.
Yes, so they confirmed they're continuing the reduction, but at that slower pace they announced back in March.
Right. The caps are $5 billion a month for treasuries and $35 billion for mortgage-backed securities. Just briefly, what does that shrinking actually do?
Think of it as the opposite of QE, or quantitative easing. During the crisis, the Fed bought lots of assets, expanding its balance sheet to pump money into the system.
Yeah.
Shrinking it gradually removes some of that support. It's another way of sort of tightening monetary policy, albeit more subtly than rate hikes.
So sticking with that plan, even with tariff worries, suggests they're still focused on that gradual tightening path.
It seems so. A measured approach.
And finally, just a small housekeeping note from the meeting itself. The decision on rates was unanimous.
Right. Everyone on the committee agreed to hold steady.
Though Kansas City Fed President Jeff Schmid couldn't make it, apparently due to a personal matter.
Yeah, and his alternate, Neil Kashkari, voted in his place, based on the reporting. It just gives a little insight into the mechanics.
Okay, so wrapping this all up, our deep dive today really seems to show the Fed is firmly in wait-and-see mode on interest rates.
Yeah, cautious observation is the name of the game. And the main reason seems crystal clear. Uncertainty.
Especially uncertainty caused by these potential tariffs and what they might do to inflation and jobs.
Exactly. They're stressing that commitment to keeping prices stable, and they're not jumping the gun on rate moves. They want to see the evidence first.
Which brings us to a final thought for you, listening. Given everything we've discussed, this strong labor market clashing with worries about tariffs, mixed signals everywhere, what factors do you think will ultimately tip the scales? What will be the most crucial element driving the Fed's next decision?
It's a really complex puzzle right now. No easy answer there.
Definitely something to keep thinking about. Thanks for joining us for this deep dive.
That's it for today's Decode. If you found this helpful, make sure to subscribe, and we'll catch you tomorrow, right here on Nora and Noah Decode the Day.